Nice to see you all again, and welcome back to another webinar organized by Princeton for everyone worldwide. We are here today to talk about industrial policy with Ernest Liu, also from Princeton University. Hi, Ernest. Good to see you.
Good to see you, Markus. Thank you.
Thanks a lot for telling us today something about industrial policy. Before we pass on the mic to you, a few opening remarks by myself. Industrial policy is big in the news. This I took from a recent IMF working paper, and you can see how dramatically, essentially, industrial policy is in the news. So it's way more mentioned, and it's actually one of the big issues people talk about in the policy circles. If you look at a recent paper by Danny Roderick and others, you can also see that industrial policy is also in action. So there's way more implementation of industrial policy in the recent years as well. So it's not only in the news, but it's also applied excessively or to a large extent in the real world by various policymakers. Just think of the Inflation Reduction Act and many other CHIP Act and many other measures, which you can see as a industrial policy action. Now, what is industrial policy and what are the motives? Of course, one motive is to correct for some market failures. So one would be externalities. Instead of using Pigouvian taxes, you try to correct some other externalities. There could be some agglomeration failures, which the market doesn't fully internalize. Or, in particular, some infant industry, where you promote some new industries, or also on the science side, DARPA in the United States, where there's a lot of innovation going on, which lays the groundwork, which leads to subsequent industries. There might be some increasing returns to scales, economies of scales, which you cannot exploit fully because individual firms might not have the financial capacity and not the access to financing to set this up. Think about large language models. That's essentially only few companies can actually do that. Or there might be also coordination failures, which need to be corrected. Some firms might need the action of other firms, and they can't coordinate to invest in the same direction at the same time. And so the action would be to bring players together. Or it might be that we need some public inputs, some public goods, some activity-specific ones. And you can think of resilience as a very important public good, whereas the system is resilience. Think about supply chains. And you would like to have some resilience if something were to go down, if something doesn't work, that you can actually substitute and scale up some alternatives very easily. You might also want to do some industrial policy for geopolitical reasons, because you might be subject to blackmailing if there's market power, and so certain choke points you want to avoid. And might be some national securities and the sanctions, which might also fall in the broad sense of industrial policies. And finally, there are also regional policies, which are, to some extent, industrial policies. So all of these motivations lead governments to intervene and conduct certain industrial policies. But the key, essentially, is that you need some good governance because industrial policy invites essentially some crony capitalism. So the question is, which firm should you favor? Which sector should you favor, and by how much? That's an information problem. How should the government find out which firm is the innovative one, which changes the economic landscape down the road? And, in the future, will the good jobs really be with the manufacturing sector, with the industries for industrial policy, or will we move much more to the service sector? And can industrial policy be extended to the service sector as well? But in general, the industrial policy invites a lot of lobbying effort. And Martin Wolf, in a recent article in the Financial Times, put it nicely. He says, governments may fail to pick the winners, while losers may succeed in picking governments. I think that puts it very nicely how, in the dangers of industrial policies. The other question is, should you favor some upstream firms or downstream firms, or within a network? I think Ernest will tell us more about that. And should you favor some micro-innovations? Or should you favor some moonshoots or mission-driven innovations, some broader sense? Or should you subsidize individual R&D projects? Or should you just buy the end product of something? But in general, it's essentially industrial policy is not promoting competition. It is favoring one or two firms or one or two sectors. And the question is, when is this justified? And can governments do a good job? And what governance structure do we need in order to ensure that? Now, if you put this whole thing in international context, it has, of course, implications. If you favor certain industries, the industry will be more competitive at the international landscape. And that actually will lead for a tit-for-tat relationship with other countries and other trading blocks. Some countries will favor certain industries, others will then put on some tariffs because I think there's an unfavorable treatment of their own industries if they don't put up tariffs. And this could undermine all the international globalization which we have experienced in the last few decades. So that's essentially what some of these challenges. And that's essentially what's going on. Now, the poll questions Ernest put forward are the following ones, and let's see how you voted. The first question is very much related to what we discussed. Can policymakers really successfully identify market failures and select the right sector to promote that? And the answers are what you have given us is 38% thought, yes, the government can do it. They're very good at that. And 62% no, the government cannot do it. So the majority, almost 2/3, say the government can actually not do it. Now, some of industrial policy is regional competition and creates incentive to use industry policy to accumulate economic leverage. This is a negative, zero, or positive sum game. Negative says 33%, zero say 29%, and positive sum games 38%. It's roughly equally split. Positive sum game gets the edge with 38%. And the third question is the revival in interest in industrial policy among academics, but also among policymakers, is it a fad? Is it here to stay? Or it's simply recasting of ongoing policy debates like trade policy, R&D policy. It's just a different way of phrasing things. It's just a fad, 7% said, so it is here to stay, 37% say. Or it's simply just recasting some ongoing policy debates, 56% said. So 7%, 37%, majority, 56% said it's just a recasting of existing debates, correcting market failures we had before. So with these answers to Ernest's questions, I pass on the phone to Ernest, who will enlighten us about industrial policy, and he will give his perspective potentially also to these questions. Thanks again, Ernest, for doing it.
Great. Thank you all for being here. Thank you, Markus, for providing this platform as a public good. I've benefited very much as an audience from past episodes. So it's great to have this opportunity to present here. And the answers to the poll questions are surprisingly even split, which I'm very happy to see. So part of Markus' introduction also anticipated my opening spiel about how to think about industrial policy. So in the context of this talk, I'm going to define industrial policy as the selective intervention by the government to promote or to push resources into certain key economic sectors of technology with some kind of aggregate objective in mind, aggregate efficiency or economic growth to achieve through potentially selective intervention. Now, it's historically, it's been widely adopted in many parts of the world, especially in East Asia. So many of the so-called success stories come from episodes in East Asia, so Japan in the 60s and 70s, South Korea 70s, 80s, modern day China. But there's also this revival, as Markus has shown, of the interest in policy circles in the US and Europe. Now, industrial policy, as part of the introduction that Markus gave, it takes many forms. Historically, it facilitates the formation of conglomerates or the chaebos in South Korea. In China, they take the form through state-owned enterprises occupying many of the key sectors in the Chinese economy. They can take form of directed or subsidized credit to certain sectors or R&D subsidies. And more relevant in the US, the Chips for America Act or the Inflation Reduction Act for green innovation. Essentially, nowadays, it's become an umbrella term to cover government interventions that target the supply side or selective intervention on the production side. Historically, it's primarily been the narrative of industrial policy is to focus on correcting market failures or externalities, for example, taking advantage of learning by doing or infant industry. And as part of the modern revival, it's being used or at least proposed to potentially address supply chain resilience, to facilitate technological growth and international competition, or building up of international power through geopolitics, and so on. So how to conduct industrial policy? That is a question that I will hope to shed some light on in the talk today. Now, conceptually, because economic actors, firms, sectors, technologies, countries, they're all linked with each other through various connections, through import-output linkages, through spillovers, through trade. Policy that target one sector will unambiguously have ripple effects through these linkages that affect many other sectors. So it is important to think about these network linkages when trying to identify the so-called strategic or pillar industries or the key technologies to promote. In fact, Hirschman, who is an early pioneer on thinking about industrial policy, emphasized the importance of both input-output linkages and trade linkages for thinking about both economic development and also building national power in an international stage. So in thinking about how to conduct industrial policy, one needs to recognize a key difficulty conceptually in assessing how effective a policy intervention is. It's just very difficult to evaluate whether industrial policy is successful. That is, what we can do, what policymakers can do empirically is to do careful cross-industry studies, compare before-after outcomes using the different strategy to compare outcomes between, say, treated and controlled industries. But such studies by design do not inform us about aggregate effects. So for instance, as an outcome of the Chips for America Act, if we see that the US developed semiconductor industry because of the act, do we view that as a success of the policy or not? In general, these policies are designed with some aggregate goal in mind. So the fact that semiconductor as an industry grow because of the act, that's by design. It doesn't point towards success or failure of the policy design. To evaluate whether a policy package or some kind of intervention is effective, the proper counterfactual will be an otherwise identical economy that didn't promote the semiconductor industry, and such a counterfactual doesn't exist in practice. So that's where economic theory comes in. That is, we can use economic theory to think through the general equilibrium effects and to think through what are the aggregate implications of selecting specific sectors. So because, in general, even with that conceptual difficulty addressed using economic theory, we still need to think carefully about what are the information required to implement some kind of theory in trying to understand industrial policy in the data. So for instance, if economic theory says we should intervene and promote sectors with high externalities, but we can't measure externalities, or it's hard to measure, there are lots of measurement error, then the theory wouldn't be very useful. So when writing down economic theories that guide industrial policy, we as academics need to bear in mind on having empirical handles that are useful for policy prescription. What are the observables in the data that can guide us with policy prescription? And in this talk, the empirical handle will be some kind of network characteristics. There are also political economy considerations, such as objectives or incentives of policymakers that I will briefly touch upon. So in this talk, I'm going to cover a selection of academic works that I've been part of in trying to identify different or distinct economic mechanisms that make certain sectors strategic in a network. And each of these studies I'm going to talk about will aim to derive some policy relevant measure from the data that we can actually measure in the data that's not so susceptible to measurement error. Now, this industrial policy is a large literature with a long tradition. So the work that I've been doing built on many of the prior work and gets inspired from many of the contemporaneous work as well. But the talk will mostly focus on the work that I've been involved in. So I'm going to talk about two papers that relate more closely to economic development, and then two pieces of work that are closer to technology adoption or R&D that are potentially more relevant for advanced economies like the US or the Europe. So let's start by looking back in history. Let's think about South Korea in the 1970s. What this figure shows is a visualization of the input-output table of South Korea. in 1970. So each column and each row represent an industry. The columns are the input supplying industry, and the rows are the input using industry. And the size of the cell are drawn in proportion to the fraction of the column industry's output that's being used, that's being sent to the row industry. So this cell, for instance, this particular column industry sends a lot of output to this row industry. Okay, so the ith industry in the row and the ith industry in the column is the same industry, hence there's a strong diagonal here. And industries here are organized by standardized industrial codes. So typically, you're going to have agriculture sector at the beginning, and then light manufacturing, such as textiles, as the next group, and then heavy chemicals, and then services towards the end. So what do we learn from this input output table? It seems like just a random figure that's completely chaotic. I'm going to do two simple operations to the table to try to bring out some pattern. First, I'm going to remove the small entries so that only big cells will remain. Second, I'm going to reorder the sectors according to upstream. So I'm going to first show to make the most upstream industries appear first and most downstream industries appear last, according to the notion of upstreamness that's widely used in the literature, Antras et al. So once I do those two operations, rearrange industries by upstreamness and then remove small entries, this is the remaining input-output table. Now, I want to highlight a few features. So how do we read this? Well, think about the most upstream industry. This column is applying to many of the industries that are all relatively upstream. And if we look across the rows, the last row, which is the most downstream industry, it's buying from all the industries before it, in the sense that the downstream industry is buying inputs from many of the upstream. And this network or this input-output table is highly asymmetric. It's almost lower triangular, which means once we order industries by upstreamness, upstream sectors don't buy from downstream, downstream buys from upstream. And there's this hierarchical structure in the sense that relatively more upstream sectors supply to downstream sectors that are closer to it. So, this part is very sparse, yet this part closer to the diagonal is very dense. Okay, so this is the hierarchical structure illustrated when we buy after we organize the industries.
Ernest, can I ask
now if we
picture look if we had a very perfect upstream downstream structure? So no downstream firm would ever produce for an upstream firm. Just hypothetically.
So if it's a vertical production chain, meaning one supply to 2, 2 to 3, 3 to 4, the only cell that will be activated will be off diagonal.
Okay.
And if one can supply to 2, 3, 4, 2 can supply to 3, 4, 5, 6, it will be perfectly lower triangular.
Okay.
So this is much closer to a lower triangular matrix, and that's a feature. It's a feature of South Korea shown here, but it's a feature of many real-world input-output tables. So some of the theory will take advantage of that feature. So why do we look at South Korea in 1970s? Well, it turns out between 1973 and 1979, that's when South Korea actually implemented this large-scale industrial policy episode called the heavy chemical industry drive, where they dumped resources onto 6 broad strategic sectors, and a lot of these are large-scale interventions. You can think of that as a big push intervention, and many of the subsequent conglomerates were formed as an outcome of intervention during this period. So South Korea essentially subsidized steel, non-ferrous metal, shipbuilding, machinery, electronics, petrochemicals. It's called the heavy chemical industry drive because of the industries targeted. In this figure, I'm highlighting the rows that correspond to industries that were targeted. As you can see, all the target industries were very upstream. Okay, so the heavy chemical industries occupy only in the first half of this input-output table. So heavy chemical industry drive, HCI drive, targeted upstream sectors. And that looking back in history, that's actually a feature of also many of the East Asian interventions. So one country that I had better data for in the context of China, China also provided significant subsidies to these upstream sectors. So if we look at sectoral value added that's accounted for by state-owned firms. The fact that many sectors were occupied by state-owned firms which receive explicit and implicit subsidies from the government, that's a feature of sectors being targeted by industrial policy. So here I'm plotting state-owned shares against upstreamness. You can see upstream sectors disproportionately have more state-owned firms, or receive more resources from government. So it's a common feature, not only of South Korea, but of
enterprises are less productive than non-state-owned enterprises. How does this show up? It doesn't show up here in this figure, I guess.
It does not show up
value
here.
added
So,
smaller, I guess. Is this part of the value added, the productivity of the firms?
Yeah, so here we're only calculating value added, disregarding the fact that these firms may be inefficient. So state-owned enterprise may be a very inefficient way for the government to promote certain sectors, but it is a way to promote certain sectors regardless. And what I don't have on the slides is so this figure is drawn using 2007, which, that's why in many sectors, the state-owned share is not very high. It's high only in the very upstream sectors, heavy chemicals. If you draw the same picture in the year 2000 or 1998, it would be a flat line that's about 60-70% state-owned across many, many sectors. And the fact that, it goes from a uniformly high state-owned share economy to a state being more present in upstream sectors, it's not only due to selective privatization, but in fact, there are many newly established plants in these upstream sectors in the early 2000s. The state is not only selectively privatizing the downstream sectors, but they're also building new plants in these upstream sectors. It's evidence of active government intervention in these sectors. Okay. So,
one question in the audience, upstream, downstream categorization in terms of industry or firms within industries?
Yeah, all of these are in terms of industry. So in the context of both, so South Korea, each column and each row where these tiny dots represent would be a sector. I don't remember the exact level of aggregation. In China, it's about 120 sectors. In South Korea, I don't remember the exact number, but similar order of magnitude in terms of number of industries. So I'm only measuring upstream.
Another question. It's only manufacturing, or does it include services as well?
So in when I show a picture of input output table, it includes all industries, meaning agriculture and services, because all of those information are present in the input output table. When I use firm level data in the context of China, it's based on manufacturing surveys. So in this figure, only manufacturing firms are present. Great. Okay, so the starting point of the first study I'm going to show is to try to understand, can this type of intervention make sense? I picked East Asia because these seem to be success stories of industrial policy. Can this selective targeting of upstream sectors benefit the aggregate economy? So I will not show you the details of a model. I'm going to lay out the economic intuition using a simple example and then show you some empirical measures in the data. So let's consider a vertical production chain where there are three sectors of the economy. An upstream sector, think of it as producing iron and steel. A midstream sector two, think of it as producing machines, and downstream produce textiles, which is what the consumer actually care about. So each sector uses the input from the previous sector as well as combined with labor in order to produce the output. Now, suppose there are some market imperfections along these intermediate transactions. So think of the market imperfections as financial constraints, but you can microfound it using contracting frictions or markups and so on. That is, the textile producers, they would like to buy more machines given the prevailing market price, but they couldn't because of some financial wedge. So they're using inefficiently low number of machines per unit production. And let's suppose the machine producers would like to buy more irons, but they're also financially constrained in doing so. What should the government do in this case? Well, a textbook answer, which is also a trivial answer, is for the government to intervene and give subsidies and taxes to exactly offset the market imperfection. Then the first welfare theorem will hold. That's a trivial answer because of first welfare theorem. That's also a not very practical answer because that answer relies on accurately measuring the market imperfection. If you can't measure the market imperfection with enough precision, government intervention may actually backfire and actually create more harm than good. So instead, I'm going to consider a different exercise, not what the government should do optimally, but let's think about, given that there are market imperfections in a decentralized economy, what's the bang for buck if the government can provide a marginal subsidy? So I'm going to think about an inefficient decentralized economy, and the government can collect some taxes from the consumer and provide in terms of production subsidies by targeting each sector only in a small way as a first order approximation around a decentralized economy. Which sectors do the subsidy have the highest general equilibrium effects? That's which sector we should prioritize in promoting, according to this notion of which sector to target. So market imperfections in the economy distort the use of inputs, right? So when textile producers, they're constrained, the production machines become inefficiently low. And when machine producers are constrained, the production of iron and steel become inefficiently low. And labor, which are the ultimate production resources, they have to go somewhere. Markets have to clear. So in this sense, the distortionary effects compound in a way that too little labor is used in upstream production and too much may be used in the downstream production. And this notion of which sector is too inefficiently small and which sector is too inefficiently big is robust to the size of market imperfections. No matter how large are the market imperfections, as long as they exist, marginally, the bang for the buck is always highest if policy tries to promote upstream and make it slightly bigger, or tax downstream and make it slightly smaller. So in this sense, subsidizing upstream sectors create first-order welfare gains. Now, how effective, what's the actual bang for the buck depends on the size of the distortions of market imperfections, but the prescription that the first dollar going to upstream will create aggregate gains, that is a robust prediction that doesn't really depend on how large are the market imperfections. So that's a feature that we're going to bear in mind when we go to the data. Yep.
Do you impose some distortionary taxes at the downstream firm in order to raise revenue to subsidize the upstream firm? So do you have some labor taxes?
No, I don't do that. I think about taxes now distortion. I can create a lump sum tax of $1 and give it to different sectors. So the only thing that distort the use of the only thing that distort the economy is the tax itself, not from raising fiscal revenue, just to simplify the analysis. So we can generalize this into just a general network structure. Okay, let's talk about the difficulty of measurement a bit later. Let's suppose that we can measure everything in the economy, meaning we can observe the input-output structure of the economy, and we can observe how large are the market imperfections. In that context, we can derive a measure, what I call distortion centrality, which measures the ratio between how large a sector should be versus how large a sector actually is in equilibrium. And this gap, this ratio, or the distortion centrality, basically captures where the policy should intervene, should spend the first dollar. So this notion of distortion centrality, it's a scalar per sector and has several intuitive properties that I'll go through. Markus, you have a question?
I just want to understand. So theta is a matrix and D is a matrix, or is it a vector?
Yeah, D is a matrix in the sense that every pairwise interaction can have its own distortions. Some goods may be more pledgeable, other goods less pledgeable. It doesn't quite, So it's casted in a general way to have pairwise distortions.
Okay, so but let's suppose there are no distortions, then a D will be 0, or
D will be identically 1. So I'm defining the distortions as the wedges. So 1 is the case where there are no distortions. Okay.
And just can you explain the beta prime? That's a vector. The prime is just a transpose. Is this correct? Or
it essentially captures each. So for each sector, I calculate what is the fraction of output sent to the consumer versus what's the fraction of output sent to each individual producer. This is the fraction sent to the consumer. This is the matrix encapsulating the fraction sent to other producers.
So if we go back to your simple example, essentially the beta for the first two industries will be 0. It's only the last.
Yeah, it will be 0, 0, 1 in the example. Yeah. Okay. But the sum of thetas plus beta should add up to 1 because the total fraction of output is 1. So there's some accounting identity that need to hold. Okay. So this object, distortion centrality, it's a vector, it's a scalar per sector. And at the sector level, it captures the marginal social value of policy subsidies, assuming that we can finance the subsidy using a lump sum tax that's not distortionary. And this marginal social value encapsulates all the general equilibrium effects. So if the number is normalized so that if it's bigger than 1, subsidizing the sector raises aggregate output. If it's below 1, subsidizing the sector reduces aggregate output. So the first result is this object actually averaged to 1 across sectors. What does averaging mean here? Well, by average, what I mean is if you average the centrality using sectoral value added as a fraction of GDP as the weights, then that's a notion of weighted average by value added. This implies that uniformly promoting all sectors is ineffective, or randomly selecting sectors in expectation will have zero aggregate effects. Now, in an economy without any distortions, the distorted centrality will be identically equal to 1 across all sectors, which means subsidizing any sector on the margin has zero aggregate impact. That's also the first part of the theorem. In the presence of distortions, the distorted centrality will be, in general, have some dispersion around 1. It will be different from 1 in a generic sector, and it will be higher than 1 in some sectors and lower than 1 in some other sectors. And industrial policy raises aggregate output if it promotes sectors or subsidized sectors where the centrality is above 1. Now, this is the first.
There's no uncertainty here. The expectations means average here. It's not an expectations over some probabilities.
Yes. Right. So I'm using sectoral value added share as the measure to define the expectation, as well as the covariance that will come right now. So this measure, essentially, one can use that to evaluate government spending because it captures the bang for the buck of government spending. So if we multiply government spending in dollar amount per sector with the distorted centrality, that's the aggregate impact of spending in those sectors. And if we add up the effect across different sectors, we get the aggregate effect. And because it averages to 1, so the overall impact on GDP to first order is simply a cross-sector covariance or a regression coefficient in some normalized way. If we regress government spending across sectors on this notion of distorted centrality, that regression coefficient tells you what's the aggregate effect. So this simple covariance formula, to the extent that we can measure distorted centrality in different sectors and we can measure government spending via different industrial policy program, we can use that to evaluate what's the aggregate effect of industrial policy.
Can I just ask, this distortion centrality, how is it connected to the network centrality concept?
Yeah, so it's right next point, in the sense that sectors with high distorted centrality tend to supply disproportionately more to sectors facing loss of distortions, directly or indirectly. So a central sector in a network is a well-connected sector. A distortion central sector is a sector that supplies to many distorted sectors, directly or indirectly. So I have high distorted centrality if I supply a lot to you and you have high distorted centrality and you have faced distortion when you want to buy from me. So distorted centrality is like for each sector, we're tracing out its value added. How does my value added travel through different producers before reaching the final consumer? Each time it travels and meets some distortion, it picks that up. That's the notion of distorted centrality here. That's why it tends to be high in upstream sectors. In a vertical economy, upstream always has unambiguously high distorted centrality. Okay?
So in a sense, it's the same concept, just applied to distortions.
Correct. Yeah. Exactly. That's why it's called distortion centrality. Okay. Okay. How do we measure it? Well, the beta and theta, or you can directly read off an input output table, and we need this whole matrix of distortions, which capture bilateral functions in some sense. Now, I have met, in general, the distortions are very hard to get. So a key critique of industrial policy that's very popular in the 90s as part of the Washington consensus against government picking winners is how do bureaucrats know where to target? How do they actually even measure distortions? But I have shown you the vertical example where even though the magnitude of distortion will determine what's the aggregate effect of intervention, the ranking of which sector should be picked first doesn't really depend on the size of distortion in a vertical example. And we can actually generalize that to a hierarchical network. So, Markus asked, what does a vertical chain look like in an input-output table? The way I define the input-output table, a vertical would be sector 1 supplied to 2, 2 supplied to 3, 3 to 4, 4 to 5. Hence, the linkages are all off diagonal. In a hierarchical network is one where 1 supplies to 2, 3, 4, 2 supplies to 3, 4, 5, and so on. So it's a lower triangular network that's very sparse when you get close to the lower bottom left corner. In that network, distortion centrality also tends to correlate with upstreamness. Hence, they can be measured with some sense of robustness. That is, you need very perverse distribution of distortions for distortion centrality not to align with network in ways that are formalized in the paper. So I've shown you this hierarchical network that's hypothetical. Markus, you have a question?
Just going back to the previous slide, in a sense, your result, is it an approximation around no distortion as a log linear or linear approximation, or is it holds more generally for big distortions as well? Is there a big difference where the distortion is smaller in terms of approximation?
Yep. So it's an approximation around the observed decentralized equilibrium with potentially large distortion, but without government intervention. So I'm saying, suppose you have a world without government intervention, but it's very distorted. What's the bang for the buck of a $1 government intervention?
I see.
That's the approximation.
But it's essentially not a non-distortion benchmark. You linearize around it. You linearize about the existing economy without government intervention. And then you say, I change government intervention. How does this in a linear way change things?
Correct. Correct. Another way to answer is, if we approximate around an economy without distortion, then any government intervention will have zero aggregate effect in first order. Because that's the first law of Fifth theorem. So this is a figure of the hierarchical network, but if you remember the South Korea input-output table from the very beginning, it looks a lot like the hierarchical network, and South Korea targeted all the right sectors in some sense. Okay, this is the hierarchical network illustration using China's input-output table in 2007. It's also fairly hierarchical, and in the case of China,
can you go back to China's? Why is there a horizontal line suddenly? What is that? Sorry.
Yeah, this is a distraction. But different countries account for capital formation differently. So if you think about capital formation in a steady state economy, some sectors have separate accounting tables for capital formation. Some countries treat capital formation as part of intermediate inputs and so on. This sector here, the horizontal line, is construction. So in China, during a period where there's a lot of construction and all other sectors use the output of the construction sector, is treated all as intermediate inputs, where part of that should go to capital formation, because the only part that should be treated as intermediate input should be the depreciated part of the capital. And I think that's just an artifact of a bad form of accounting. So that artifact doesn't show up in other countries.
By the way, there's one question in the audience from Ram Acharya. He wants to know, when you do this input-output, it's only within the country, their imports, exports are not included. Is this correct?
So right now, I'm thinking about viewing this as closed economy. We can think about input-output linkages, but more on to follow. But for now, think of these as closed economy. So in China, where I have access to firm-level manufacturing data, I can use I/O methods, structural I/O methods, to estimate firm-level wedges. I treat those as distortions, and then I aggregate to the sector level. But recall that the notion of distortion centrality doesn't really depend on how I measure the distortion. At least the ranking of distortion centrality doesn't really depend on how I measure it. If I set distortion to be constant across all sector pairs, I basically get back the same answer in terms of ranking of distortion centrality across sectors. So this table on the left shows the industries that have the highest distortion centralities. these are all heavy chemical sectors. That's essentially the same set of sectors promoted by South Korea in the 70s. On the right, these are the sectors with the lowest distillant centrality, those that should be taxed. These are all downstream light manufacturing goods. I'm restricting the analysis within manufacturing goods because that's where I have firm level data. So using firm level data, what I found is industries with higher distortion centralities, firms in those industries tend to pay lower interest rates. They tend to have higher debt to capital ratio. They tend to pay lower taxes, receive more explicit tax breaks. These industries also tend to have more state-owned firms that receive more subsidies. So, all across these different policy platforms of potential ways for the government to intervene, one do see that firms in the high centrality sectors seem to be favored. Okay, so in that sense, these policies, the cross-sector variation in taxes, interest, and subsidy to state-owned firms may generate aggregate benefit. And one can evaluate those aggregate benefit using this covariance formula, where we turn that cross-sector variation in interest and taxes into some dollar amount of government spending. What I found is, across these policy platforms, altogether they account for about 6.7% of GDP. And if we change sectoral targeting by size, consumption share, or value added, or even export intensity or intermediate expenditure shares, these alternative policy target wouldn't do as well as the data. That is, the government really needs to target upstream sectors to generate as much gain as what's observed in the data. Okay.
What's DLW? Sorry.
Yeah, this is the DeLucker and Wierzyński method of specification of picking distortions, but in the paper I try to pick distortions in many other ways. So
it's their numbers.
Yeah, exactly. So it's their method applied to Chinese numbers. Mm-hmm. But all of these quantitative effects of GDP gain coming from industrial policy, they all scale with how much variance is there in distortion centrality. If you know the variance, these numbers are basically almost proportional to that because the centrality isn't so sensitive to exactly how things are measured, and different specifications just differ in this variance, essentially.
Can I ask, the financial industry, is it also part of the input-output table? And is it?
It is,
upstream?
although, yeah, it is. Different countries account for it differently, so it's a little hard to think about exactly where it is. In the US, it's fairly downstream. So most of the service sectors are fairly downstream. It's not as downstream as food consumption, but it's in between food consumption and heavy chemicals, I would say. Yeah, in China, I don't remember what the number is.
And how much does it matter how fine the input-output table is? Now, if you group more industries into one bigger industry, and you don't have such a fine granular definition, does this matter?
Yeah, so it definitely matters in two senses. One, this formula, this is derived using non-parametric production function. So if you have, S over just general jointly concave function over different inputs, this result holds because it's a first order approximation result, so you can deal with non-parametric production functions. So in that sense, the level of elastic substitution across different level of aggregation, that doesn't quite matter. But mismeasurement could still be an issue if you only have very aggregate data. I can't go from this level aggregation to finer level because that's not available. But in the paper, what I do is I try to bundle sectors together to make it more aggregated, and results are fairly robust to that. Okay, so that is a paper where I consider a closed economy. So in a closed economy, subsidizing upstream sectors is welfare enhancing. What's happened in practice in both China and South Korea? I mean, these are multi-region economies, and industrial policies are often enacted by local governments. So there could be a lot of political economy considerations with terms of trade considerations. So different local governments are essentially treating their domestic economy like open economies. In the presence of cross-region trade and input-output, there may be misalignment between local and central incentives. So that's the topic of study of this follow-up paper. To illustrate the main idea, think of this illustration with two regions in the economy. If the two regions are not trading with each other, here the three sectors are metal, concrete, and housing, a central planner will want to subsidize the metal sector. A local planner also want to subsidize the metal sector if they don't trade. Now imagine a world where each region, to build concrete, you need to import the metal from the other region. The local planner doesn't have incentive to subsidize metal because for the local planner to subsidize metal, it's only going to affect relative prices or the so-called terms of trade in a way that harms domestic economy. You're essentially sending more metal to the other economy and buying the same amount of metal from the other economy. So from a local production perspective, you want to subsidize concrete and actually tax metal production. Okay, so when regions trade, that really differs on local policy versus what the central planner would want, and the real world is somewhere in between. So in this paper, essentially we.
So let me just make sure that if the first region subsidizes metal, it is benefiting the other region's concrete firm.
Correct.
So so you want to essentially impose exit tariffs from metal, not going to the region.
Correct. So if these are actually different countries, their incentive is to impose export tax. Or actually import tariffs. Import tariffs and export tax would generate some kind of Lerner symmetry. They would have the same general equilibrium effects. But here, when within a given country, one cannot impose tariffs, but one can use industrial policy to serve as tariffs. Now, think about different economies within Europe, within a free trade zone. I understand industrial policy is also hard to implement within Europe, but if different countries can give subsidies to favor certain industries, they can essentially use that as a way to manipulate terms of trade and bypass this no tariff restriction in some sense.
But whether you have export tariffs or import tariffs, it might be equivalent, but it's not equivalent who gets revenue from the tariffs, I guess.
Right. So it's equivalent if there's some kind of lump sum transfer, but I'm not thinking about how the tariffs are redistributed. And in this study, we don't think about tariffs at all. We're only thinking about industry policy. Yeah. Okay. So what the paper does is we write down a model with cross-region trade, input-output linkage, and embed market imperfections as in the previous paper. And we derive essentially the local and central counterpart to the distortion centrality. Here we call them local and central indices for intervention, where the central index captures the local index captures the effect on local welfare per unit subsidy financed by taxing local agents. The central index captures the effect of on national welfare, some weighted sense, a weighted average of local welfare by taxing nationally in proportion to their income. But otherwise, it's very similar to the previous paper. The information required here would be, we need some kind of cross-region input-output table. So in the context of China, we created this, we obtained this province by industry input-output table. So it's a gigantic matrix, 1300 by 1300 matrix. And we estimate firm-level wedges from production data. But again, it's more of the input-output structure that's driving this rather than where the distortions are that's driving the variation. Okay, what do we do with this? So we have this index that differed by region by industry, capturing incentive for central planner and incentive for local planner. So first we want to, just to demonstrate how they differ, I'm going to show you a regression and show you a concrete example. The central planner, they want to subsidize upstream industries. So most of the variation is not across region, but across industries. It's the same as in the previous paper. The local planners, they want to subsidize sectors that are upstream, but only to local production. They don't want to subsidize industries that send inputs to elsewhere. So they want to subsidize sectors that actually export little. So if you regress the share of output sold to other regions as inputs, Well, that's a upstream sector. So central planner has incentive to subsidize it. Local planner has incentive to tax it. What's a specific example? Well, we can see it by comparing metals and concrete. Metal is highly tradable, it's an upstream input. Concrete is also a fairly upstream input, but it's not really tradable. So if we compare Beijing and Shanghai, in terms of metal products, central planner would like to subsidize them. Local planner in Beijing would like to tax metal production because a lot of the Beijing metal is sold outside of Beijing as an intermediate input. Concrete is upstream to local production, so central planner doesn't have incentive to subsidize it. Local planners in both Shanghai and Beijing want to subsidize it. So that's where the variation comes from, okay? We're going to collect interventions by different levels of government. We're going to do two kinds of empirical exercises. First kind, we're going to compare central government intervention and local government intervention. Government intervention take many forms. State-owned firms, subsidies they received, 5-year plans, different levels of government, central or provincial. They publish their own 5-year plans, which lay out a set of strategic industries that the economy should promote over the next 5 years. They also set up special economic zones with designated industrial focus. And we're going to compare central and local and provincial. We're going to show that central intervention tend to align with the central index, and the local strategic industries tend to align with the local index. Number two, we're going to look across provinces in the local targeting. What we're going to find is in provinces that are more fiscally independent from the central government, they tend to target strategic industries that's better for themselves. Whereas provinces that are less developed and rely more on the central government for fiscal transfers, they tend to target sectors that are more aligned to the central government. So this is essentially a formalization of what I mentioned. If we compare the presence of state-owned firms,
the officials in China, they knew your paper already before you wrote it. Is this fair to say? Or they understood the mechanism?
Sense, yes.
They understood the mechanism.
In some sense, yes. If you read policy documents, is my internet okay? From my perspective, Markus, I can hear your voice, but your Zoom is frozen. Can you see me moving? Or
yes, it works fine on my side.
Okay, good. Okay, so if you read policy documents, you do see mentions of network linkages, subsidizing in a sector generate. These are the pillar industries because it's going to generate a lot of spillovers, and the language describing specific industries differ between the central and local. If you look at the 5-year plans, why they designate specific sectors, language seems to suggest some of this terms of trade or externality to other regions are part of the consideration. So state-owned firms, some are centrally owned, some are affiliated with provincial governments. Provincial state-owned firms tend to align with local index, central tend to align with the central index. And if we regress the local state shares on the local index province by province and look at the pattern across provinces in that correlation, we see that the correlation is stronger in areas that receive less fiscal transfer from the central government. In terms of the 5-year plans, the central 5-year plans target central index. The provincial 5-year plans don't really target, is correlated but insignificant with both central and local. But if you look across different provinces, in the coastal region that are more financially more developed, their 5-year plans tend to target the local index. So the more west and northeast and less economic development region, their 5-year plans seem to more support the central index. These are also regions that receive more fiscal transfers. So on the map, if we look at which provinces have local policies that generate positive spillover to others, these are all the less developed region. And the more developed region actually create negative spillovers on the rest of China. And if we look at which regions receive positive spillovers, these are the regions that actually benefit from local industrial policy in other areas. Okay. So those were two studies based on developing economies, thinking about how to use industrial policy to correct for market imperfections. I'm going to switch gears and maybe speed up a little bit. How much time do I have?
Take your time.
Okay, I'll try to do it in like maybe 15, 18 minutes.
Yes, that's fine.
Great. Okay, so I'm going to switch gears to think about industrial policy for, technology, for growth, and maybe for the green transition, which are more relevant for developed economies. So this is recent work with SOMA. We think about innovation network and R&D allocation. So this is a paper where we want to understand how should economies allocate R&D resources across technology. To fix ideas, this is an illustration drawn using the patent citation network. You should know there's a one-digit patent sector. So this is semiconductors, pharmaceuticals, basic chemicals. There are these links across sectors capturing citation relationships, which are proxies for knowledge spillovers. So we want to understand, when there are cross-sector spillovers, how much resources should the society allocate to semiconductor versus pharmaceuticals?
So just make sure this is US data now, or?
We are going to look both with US and cross-country. This figure, I believe, is drawn using US patents.
And the spillovers is not citations of patents by some other field. It's the spillovers of the industries. The links between the different.
So here I'm going to define a sector as a technology. I'm not going to think about SIC code. I'm only going to think about patent classifications. And these are citation shares across patent classifications.
Oh, citation shares, okay.
Yeah. So basically, we're going to look at the network and think about how countries should allocate and compare with how countries are actually allocating and see whether some countries are doing better than others. And maybe just to think about whether, CHIPS Act or Inflation Reduction Act have some rationale based on this analysis.
So
to do this,
the connections is not directional. They're directional? Or
they are directed. The direction is just drawn there in a very small way. Okay. Yeah, but there are directions in the arrows. So to actually talk about this, I need to formally introduce the model. Otherwise, the analysis wouldn't make much sense. But I'll set up the model in one slide and go through a result in one slide. So it's an economy that consumers are forward-looking. At each point in time, they consume a bundle of different goods. Beta I captures how important is technology I in the consumption bundle. And the consumption goods are produced linearly from labor based on technology. So Q is the technology in sector I, is the level of knowledge in sector I. So this knowledge can be improved through R&D, and this is the innovation production function. So at any given point in time, Q is the stock or the state variable. The flow of new innovation is the product between how much resource we spend on innovation in that sector and the innovation efficiency in that sector. The innovation efficiency in a sector depends on some exogenous component, but also endogenously on the level of knowledge in all other sectors of the economy. Omega ij captures how important is technology J for sector I's knowledge. And the collection of this omega is what defines an innovation network. So this is a law of motion that governs how flow converts into stock. So in simpler terms, in the absence of cross-sector spillovers, this law of motion collapses down to something very simple. That is, the growth rate of knowledge in a sector is log linear in the amount of resources we spend in that sector. But in general, with cross-sector spillovers, growth rate of knowledge in a sector not only depends on R&D in that sector, but also on the relative stage of knowledge between all other sectors. And the key question is, given a stock of production and R&D resources, where production resources we allocate to produce, R&D resources we allocate to do R&D, how should the society optimally allocate across sectors? That's the question. That's the abstract question we're trying to answer.
Can I ask you, the linkages themselves are given exogenously. There's no investment that I can promote spillovers from one sector to another sector. Is this correct?
Yeah, in the baseline model, in everything I'm going to show, that's the case. So these omegas, these elasticities are exogenous. In the paper, we characterize a case where these elasticities can be endogenously changed, which essentially is just by replacing this function with some general aggregator over knowledge. So that if you define the network based on local elasticities, then a general aggregator would capture that. So the local elasticity would change. Then the result I'm going to show you, in particular, what I call a sufficient statistic that guides the empirical analysis, it will be valid as a first order approximation around a balanced growth path where you're defined using the local elasticity. So in that sense, the logic I'm going to use in the analysis is general, but what the numbers I'm going to show you treat it as first order approximation if you deviate from this log linear environment. So in general, how do we allocate resources across sectors? In abstract, it's a very hard problem because anywhere you locate R&D is going to have influence the growth of knowledge in that sector that's going to have long-run consequences on many other sectors of the economy. In abstract, is a very hard problem. Now we picked the log linear formulation so that this problem has a very intuitive solution, but in response to Markus' question, the solution I characterize has some generality in it. So here in this log linear environment,
the spillovers are immediate. No, there's no delay in spillovers.
The spillovers are not immediate. That is, the efficiency of research in sector I depends on the knowledge of sector J, which is a stock. So the spillover, number of mathematicians today doesn't benefit my research efficiency. It's the math theorems, how many math results are out there that helps my writing of this paper. So for any initial state of knowledge, the optimal allocation of resources in this log linear environment is time invariant. The labor allocation should follow a beta, which captures how important is technology in the consumption bundle. So if we as consumers value textiles, more workers should go to textiles. The allocation of R&D resources is different. It should follow a vector gamma, which should sum to 1. And in proportional terms, it's equal to the product between the vector capturing how consumers value different technology in the consumption bundle and the Leontief inverse of a discounted version of the innovation network. What's the intuition? We can expand this Leontief inverse into a power series of matrix. Mm-hmm. So the social planner is thinking about, if we allocate more resources of R&D in a sector, it's going to raise that technology in that sector, then benefit the consumer according to beta. So beta times the identity matrix, that's a direct effect. But now that sector has higher technology, in the future, it's going to benefit future research in other sectors, and then other sectors benefiting other sectors. Those are all the network effects. Those effects occur in the future, so they're discounted. And the relevant discount rate is how we discount future consumption versus how quickly those future benefits materialize. Mm-hmm. So you can see that if the society is very impatient, if the discount rate goes to infinity, all of these network effects go to 0. So for a myopic planner, the optimal R&D allocation coincides with the consumer preferences. We should all do research in what we produce. We should all do research in improving textiles. If instead the society is infinitely patient, the network terms become more and more important, and the original beta term becomes less and less important. In the limit, the optimal allocation converges to the eigenvector centrality of the network, meaning a sector is more central, it generates lots of spillovers to other central sectors. Turns out that's also the growth maximizing allocation. So in the if we're infinitely patient, we should do research with the only goal in mind, that's the long run growth. For any finite level of patience in between these two extremes, the optimal allocation is a weighted average in a vector sense, in a matrix equation sense, between consumer preferences and the vector that maximizes growth. So in general, it's always in between. Okay. Next is the result that enables us to take this model to the data. That is, suppose we can measure the optimal allocation for an economy, and we observe real-world R&D allocation in the data. We can calculate what's the welfare gain if we reallocate R&D optimally. So this term in red is also known as relative entropy of one distribution from another. It measures how far is the real-world allocation away from the so-called optimal one. It's a notion of misallocation across sectors. And with a handful of parameters, it converts into a notion of welfare loss due to R&D misallocation. So to operationalizing the data, we're going to try to measure optimal allocation and actual allocation. One elephant in the room that's a feature in the data is this is a closed economy. In the data, there are lots of spillovers that come from abroad. So I'm going to incorporate that feature. Now, essentially, the required modification is to do R&D. The R&D efficiency in sector I depends not only on domestic knowledge, but also on foreign knowledge. So the elasticity is no longer just omega ij, but it has domestic components and foreign components. But I'm still going to continue to think about a domestic planner trying to allocate R&D to maximize domestic welfare, taking all the future foreign knowledge as given. Turns out the intuition is very similar to in the closed economy case. It's just that the relevant elasticity for domestic spillovers is no longer omega ij, but only the domestic components of that. So it's the product between omega ij and xij. The implication of that is for an economy that's reliant on own domestic knowledge, as I was showing the data, it's the US and Japan, they should do R&D as if they're very patient. Whereas for an economy that benefits a lot from foreign spillovers, it's as if the domestic knowledge doesn't matter as much. That's isomorphic to a world where they have more impatient planners, so they should allocate R&D more towards sectors that they directly produce. And we also generalize this welfare calculation, taking into account the fact that, if the US mess up its R&D allocation, because its future R&D built on its prior R&D, R&D misallocation has long-run consequences. Canada free rides on the US, so domestic R&D misallocation is not that welfare consequential. So we need to make this open economy adjustment to take account of that. Okay, that's all I want to show in theory. Now I'm going to operationalize this by trying to measure optimal allocation of data and compare with the actual. So we're going to, the main object is this innovation network. We're going to measure using patent citations. So among all of the citations made by patents in a technology I, what fraction actually goes to patents in a technology J? We're going to rely mostly on this international patent data from Google Patents that combine patent data from more than 20 major patent offices around the world. So no matter where the inventor is, if you file a patent with US, Japan, China, European PDO, one of the 20 major offices, you are in the data set. And we augment that with production data and R&D information from firm level and aggregate to the technology level. Let me first show you some summary stats of this innovation network just to visualize it and then look at the optimal allocation. On the right, these are the top 10 sectors with the highest centrality. These are, you can think of the centrality of a sector capturing the contribution of R&D in that sector on long-run growth. So these are, most central sectors are medical science, computing, basic electric element, which is semiconductors, electric communication techniques, and so on. And the figure on the left plots the centrality sorted by sector. So the most central sectors are much, much more central, and R&D in those sectors are much more important for growth than the peripheral sectors. A visualization of the network.
For sometimes in certain fields you cite very easily, in other fields you're very, careful not to cite too many. Even within economics, you correct for this? And
so we try to do various ways to measure this definition, so we can weigh the citations by. But remember, this is defined at the technology to technology level. We're not really using patent level once we aggregate, but we can weigh underlying patents by the total citations or by the stock market value from Kogan et al. We can also use different scaling. That is, these things don't have to sum up to one, but the whole matrix, we have to have some spectral radius bounded by one. So we do various things with different ways to measure it. If different sectors have different propensity to file for patents, but if the influential patents receive all the citations once the field generates spillovers, our measurement will be fine. Okay. If certain fields just don't receive citations, then that's hard to characterize because that happens at the field level and this is constructed at the field level. So we don't have good ways to characterize that. Okay, this is a visualization of the citation network. The most central sectors are heavily cited by all others. The peripheral sectors are not cited very heavily by others. So the network is very asymmetric. at the country sector to country sector level, US and Japan have the most number of patents. And the distinction is US creates a lot of spillovers to other economies. Japan is relatively isolated, doesn't cite others as much, doesn't get cited as much. And finally, the important piece of information is when a country cite, how frequently do they cite their own patents? So US and Japan, 70% of citations are towards domestic patents. All other countries cite domestic patents less than 50% of time. And this is 2010. So, to first order, you can think of US and Japan as close to being closed economies. All the economies are open economies. Mm-hmm. So these are the ingredients towards the measurement of the optimal allocation, which I'm showing you now. This is the optimal allocation of the US R&D across 3-digit patent sectors. So medical science, US should allocate 6.5 to 7%, semiconductor 6%, followed by computing, automobiles. I'm going to overlay on top of that the optimal allocation by 4 other major economies: Japan, China, South Korea, Germany. Compared to the US, all these economies should allocate less to medical science. Germany and Japan should allocate more to automobiles, and South Korea should allocate more to consumer electronics. So the variation in optimal comes from mainly not the innovation network, because that's very similar across countries. It comes from differences in production structure and differences in the degree of foreign spillovers that countries receive.
Because Germany is producing a lot of cars, it should also have more allocation and vehicles.
That's exactly right. This figure shows you how actual allocation compare with the optimal allocation. Actual on the Y, optimal on the x-axis. Mm-hmm. And with line of best fit. You see across all of these economies, sectors that should have more resources do end up getting more R&D resources. This is not obvious, it's not mechanical in the data, because the Y and x-axis come from completely data sources. X-axis come from patent citations. Y-axis come from aggregation of firm-level R&D. These are different data sources. And in particular, some economies, the optimal allocation, the line of fit is indistinguishable from 45-degree line. Although the line of fit being 45-degree doesn't imply the country is allocating resources optimally. There's still a lot of dispersion around the 45-degree. If you move allocation vertically towards the 45-degree to close the gap, that improves welfare. And the relative entropy measure of how far is the y-axis away from the x-axis tells you what's the degree of inefficiency, which is what the theory provides in how to interpret these dispersions, and is what we're going to show you next. So this figure essentially plots the relative entropy, which is a notion of R&D misallocation that's comparable across countries. Japan, South Korea, Germany, and the US have the most efficiently allocated R&D across technologies. Russia has very bad allocation. The last column is European Union by aggregating the EU together, treating it as a single economy.
But it seems to me that smaller countries like the Netherlands or Austria, they're much less efficient. Is there a size component to it too or not? No.
It's not. So this is directly coming from the data. Country size doesn't necessarily correlate with degree of inefficiency. The European Union, for example, would be larger than each individual country combined, and this is not lower. So in this talk, I don't have time to talk about what could be the predictor, but I don't have slides prepared to show that. But what we find is essentially what's the source of inefficiency in R&D. If each firm only conducts one innovation, it's going to ignore all the spillovers. But if the firm conducts one innovation and itself in the future builds on it, then the firm will internalize innovation. So in that sense, Samsung, Sony, Siemens, Google, Apple, all of these firms that do fundamental research in ways that benefit its own future research, that helps correct for some of the externalities. So what we find in data is in countries where innovation activities are more concentrated, a few firms that account for most patents, allocation tend to be more efficient. That's one very strong predictor. But anyway, coming back to the slides, we can compute what's the welfare loss due to the misallocation. So, in economies that are more self-sufficient and rely less on foreign, the gray bars are comparatively taller compared to the red. In economies where they benefit more from foreign, the gray bars are lower. So domestic misallocation matter less for welfare, given the same degree of misallocation. In table form, in the US, 2010 misallocation correcting for that can account for 8% consumption equivalent welfare gains. Germany, 4%, Japan, 5.6%, higher in Russia. Now, the model also has predictive power about which sectors are over or under allocated. In particular, we can zoom in on key industries of interest, for example, semiconductors, and compare how the US does compared to East Asian economies. So in semiconductors, US under allocates by 21%, Japan does just about right. China and South Korea over allocates more aggressively, provides potential support for the relevance of Chips for America Act and the recent policies to support semiconductors.
So these numbers are before the CHIP Act, or
before? These are all before that. Yeah.
Okay.
Yeah. So so first, it takes a while for CHIP Act to actually generate any effect, and it takes a while for firms' R&D data to actually materialize, and we don't have that precision. In terms of green innovation, US also under allocates relative to East Asian economies. Notice that this is not about, we're not taking into account any environmental externalities. This is purely based on how important is green technology in the consumption bundle, and also how much citations green technology receive from other sectors that's important in the consumption bundle. US underfunds about 25%. Okay. Let me briefly talk about one slide to talk about this last topic, and then I'll conclude. So, in this other paper, we think about how to use industrial policy to correct for coordination failure in a dynamic context. In particular, we want to think about it in terms of green transition, green technology along the supply chain. Now, this green transition really requires the switching along the entire supply chain, because if we think about transitioning from gasoline cars to electric vehicles, the latter requires batteries. The production itself is emission intensive. So while there's broad consensus worldwide on the need to speed up the transition, countries tend to diverge on how to achieve the goal. In Europe, most of the policy tend to focus on carbon tax or cap and trade. In the US seems to be more open to targeted industrial policy to facilitate the green transition. So in this paper, in this paper I briefly discussed, we built a dynamic model of transition, which features strategic complementarity of the following form. Think about an EV producer. If we take into account the environmental cost, right, we're thinking about, maybe green production is cheaper once environmental costs are taken into account. For the EV producer, if producing battery is still very dirty and generates a lot of pollution, then it's actually environmentally expensive to produce an EV. Likewise, if there are no demand from EV producers, there are no EV producers, there's no incentive to actually greenify the production of batteries because there's no market for it. So there's strategic complementarity along the supply chain, but it's very different from big push, where all the externalities come from demand. Here, the externality come from both the cost side and the demand side. The demand externality travel from downstream to upstream. That is, if more EV producers create demand for battery producers to greenify, more battery producers that become green reduces the total social cost of producing electrical vehicles, generating more incentives. So the directional nature of these two different forms of externalities along the supply chain generates several new insights highlighted by this paper. That is, implementing the social optimal requires both a carbon tax and targeted subsidies. So uniform or just cap and trade or carbon tax doesn't work. Second, as opposed to big push theory, which says the government need to use industrial policy to intervene in many sectors simultaneously to create a big push, maybe for a sustained period of time in order to have any long-run effect, that's no longer true in this setting. Small and temporary subsidies, what we call small nudges to key sectors, can generate long-run impact. And what are those key sectors? Well, if the subsidies are limited, they should primarily target downstream sectors, because the downstream market size created from downstream sectors travel to upstream inputs 1-for-1. 1% more EV producers create 1% more demand for batteries. On the other hand, the other side of incentive travel less than 1-for-1 because EV uses not only batteries but also labor and other inputs. So the cost reduction from batteries doesn't translate 1-for-1 into cost reduction in EVs. We also create several examples to show misdirected.
Just to make sure I fully understand, because earlier in the first part of the talk, you said, oh, we should actually intervene at the top of the supply chain. Correct. Now we say we should intervene at the bottom. What's fundamentally different?
So, which I'll talk about that distinction again when I conclude that, policy prescription really depends crucially on the underlying mechanism. In the first paper, it's the accumulation of distortionary effects due to market imperfections in a network. In that world, policy has the highest bang for the buck to subsidize to expand the most distorted sectors, which is upstream. Here, the market failure comes from coordination. It's not really so coordination. And it really depends on, if you give a sector a subsidy, what's the impact of additional decentralized incentives can be created from the outcome of that subsidy. So it really depends on how much does demand externality travel through the network versus how much does the cost reduction travel through the network. These are very different economic forces, hence they call for different intervention. And we show that misdirected or delayed policy intervention can permanently derail the green transition. So that's a recent working paper.
So the other question I have, the carbon tax versus industrial policy or supply side policy depends, of course, a lot on your fiscal space as well. Many European countries probably cannot do this huge subsidy because they get into fiscal difficulties. Yeah. You don't consider these aspects.
Yeah, that's an aspect that that so far I have not considered in any of my work. And there are also, just many other practical difficulties with policy intervention. As you mentioned at the beginning, one practical problem is there's a lot of bureaucracy, corruption, or lobbying. How do we ensure that given even a benevolent planner, a sound economic plan with a policy target, how do we ensure the policy funds go to the right actors? All of these practical difficulties with intervention, both in the actual giving out the subsidy versus raising the fiscal revenue versus political feasibility of policy. My work has so far not touched up on those forces. Instead, I treat those implementation issues aside and only think about if we can collect lump sum tax and conduct intervention to different sectors, what are the policy prescriptions coming from first principles interacted with the network? Okay. Which this discussion is a great segue into my conclusion in that how to conduct industrial policy depends crucially on the underlying mechanism. We have seen, accumulation market imperfections, target upstream. With cross-sector externalities, we have to be careful about the incentives of the local planner and different political and economic considerations. With knowledge spillovers, we want to target central sectors, but only to a certain extent, governed by how forward-looking the society is and how much do domestic spillovers actually matter. With coordination failures, at least in the context of technology adoption, we want to subsidize downstream to generate the most incentives along the supply chain. So one observation that I want to make here is none of these mechanisms are new to economics. All of these are very old mechanisms that have been studied, just not in the network context until recently. So, the fact that these mechanisms, that these old, well-studied mechanisms interact with networks and have so many new predictions in ways that can connect to the data, that's just super exciting. So, different mechanisms interact with network, and that calls for new models and new theory and new ways to measure the mechanism in the data. And really, there's no a single umbrella, one-size-fits-all prescription on which sector to target. But that's also the beauty of why the subject is so interesting. So that's where I want to conclude.
Great, thanks a lot, Ernest. We ran over big time this time, but that was very exciting.
I apologize.
Perhaps a final word. What's about in the endogenous network formation that you try to influence the network itself? That probably some policies along that line. How would you categorize them? These type of policies?
Great question. That's something of interest to many people, including myself. I haven't done any work on that, so I don't know.
Okay. Future work.
So in the sense, I gave a shortcut-ish answer in the R&D network, also the production network. The network can be endogenous, but as a local approximation, those considerations are not that big. But I have not done any analysis where the endogenous network structure is the focus of the analysis. That's a great area, though.
Okay, great. Thanks a lot, Ernest. It was fascinating, and we learned more. Essentially, there are a lot of challenges ahead to really do if we want to do industrial policy, how to do it right. And we have to take all these first order mechanisms into account, where to intervene, what's the best way to intervene. And then on top of it, there will be all the political governance issues we have to think about. Thanks again. And thanks to all of you for the audience, and hope to see you next time soon again. And I wish you a great weekend. Bye-bye. See you soon, Ernest.
Great. Thank you.
Yes.
Bye-bye.
Bye.